Let's jump right into this explainer. Today we're stepping into the high-stakes world of the corporate financial close process. Now, a lot of folks think accounting is just straightforward number crunching, right? Just balancing the books. But honestly, at the highest corporate levels, it is a thrilling investigation. It's really all about securing the absolute integrity of financial data before it goes out to the world. So, we're going to put on our detective hats and walk through the exact steps, the controls, and those hidden tripwires that make up the corporate close.
So, let's tackle this head-on. Where does financial fraud actually hide? If you're picturing someone just skimming cash from a register, well, think again. In large organizations, accounting is definitely not mere data entry. It is an active hunt for anomalies, unintentional errors, and, most critically, intentional management override. You see, the close process is where the financial story is finalized. And because of that, it's the exact place where someone might try to rewrite that story.
Here's our detective's roadmap for this explainer. We'll be looking at high-risk journal entries, complex close entries, the power of reconciliations, intercompany transactions, and finally, the trial balance sign-off. Let's get right to it.
Phase 1. High-risk journal entries.
Journal entries are basically the primary mechanism for adjusting accounts at period end. That makes them our prime suspects when we're looking for manipulation. You can see how the risk levels vary here. Standard and automated entries, those are lower risk. They're repetitive, system-generated, and locked down by IT. But look at the manual and top-side entries. Manual entries involve human judgment for one-off situations, like setting up a warranty reserve, which throws them right into the highest risk category. And even riskier, top-side entries. These are posted at the consolidated level, usually after the subsidiary entities have already closed. External auditors specifically target these because the potential for management to just override the system is highest right here.
Now, because those manual entries carry such incredible risk, there's a golden rule under SOX or SOX, segregation of duties. Simply put, you cannot grade your own homework, and you absolutely cannot approve your own million-dollar manual entry. The person who prepares a manual journal entry above a certain materiality threshold just cannot be the same person who approves it. This is a totally non-negotiable internal control. You've got to have an independent approver, like a supervisor or the controller, to make sure the entry is actually legitimate and properly documented.
Okay, so what exactly are auditors looking for when they scour these entries? They're hunting for very specific red flags. They're looking for entries posted to unusual accounts or stuff that comes in super late in the period, maybe even post-close. They definitely look for entries made by people who normally wouldn't touch the system. I mean, if the CEO or CFO is posting directly, that's a huge red flag. They also scrutinize nice, round number entries that don't have any backup or entries clearly designed to offset or hide prior period errors. Seriously, a last-minute, undocumented top-side entry that magically reduces a liability just to instantly boost income? That is a classic pattern of financial statement fraud.
Moving to Phase 2. Complex close process entries. These are the highly judgment-intensive entries that happen at the very tail end of the reporting period. In the earlier stages of the month, you've got your standard accruals and estimates. But entries 11 through 16 here, these are the heavy lifters that connect upstream cycles to the final balance sheet. We're talking intercompany eliminations for sales, purchases, and balances. We've got profit eliminations for unsold inventory. And then the really big ones, correcting errors in the current period, adjusting for a retroactive change in an accounting principle, or reclassifying other comprehensive income to the P&L. It's complex mechanics for sure, but it ensures the final picture is totally accurate.
There is a really vital concept to understand about those intercompany entries we just saw, entries 11, 12, and 13. They occur only at the consolidated level. You are never going to find them in an individual entity's own local books. Why? Well, because they exist specifically to prevent a company from artificially inflating its consolidated results by essentially doing business with itself.
Phase 3. The power of reconciliations.
If journal entries are all about recording the story, reconciliations are about corroborating it. Every single balance sheet account has to be reconciled to supporting documentation before the period can officially close. It's not optional, it's absolutely foundational. But here is the catch. There's a ticking clock. Reconciliations generally must be completed within just 5 business days of the period end. If you're working with stale reconciliations that haven't been updated for the current period, you've got a massive control deficiency on your hands. The pressure is really on to get this done accurately and incredibly fast.
To do this correctly and stay SOX compliant, accounting teams follow some very strict steps. First, they pull the general ledger or GL balance. Second, they match it to a supporting schedule or subledger. Third, and honestly, this is where the real detective work kicks in, they have to explain every single difference or in-transit item. Finally, they secure formal sign-offs from both the preparer and an independent reviewer.
Let's look at how this builds into the broader control environment. Your operational subledgers, like AR, AP, and inventory, they must perfectly match the general ledger. Any difference whatsoever means a transaction posted in one system but not the other, or maybe an integration failed. If a subledger to GL difference isn't fully resolved before the close, it's officially classified as an internal control over financial reporting, or ICFR, failure. The financial statements literally cannot be finalized until these systems match up perfectly.
Phase 4. Untangling intercompany transactions. For companies with multiple legal entities, this is a seriously complex maze. Different parts of the same parent company are just constantly doing business with one another. Entity A might sell inventory to Entity B, or maybe Entity A lends cash to Entity B. You got management fees, shared service charges, and dividends passing back and forth all the time. But remember, when we zoom out and look at the whole company as one single consolidated entity, all of this activity has to be completely eliminated. You obviously can't owe yourself money, and you definitely can't make a profit by selling to yourself.
So before the consolidated close can proceed, all these intercompany balances have to agree. If Entity A says Entity B owes them $1 million, Entity B better have that exact same $1 million recorded as a payable. If they don't match, you've got an intercompany out of balance, and the team must investigate immediately. They have to figure out if it's just a timing issue or maybe a foreign exchange rate difference. They apply a strict FX cutoff policy and escalate any unresolved differences right away.
Phase 5. Trial balance and sign-off. Okay, so all the journal entries are in, the reconciliations are done, and the intercompany maze is completely solved. Now, the adjusted trial balance is generated. This is where the controller steps into the interrogation room and hunts for anomalies. What exactly are they looking for? Well, they're scanning for account balances with unexpected signs, like, say, an asset sitting there with a credit balance. They check for accounts that have zero balances, but definitely should have had activity, or activity in clearing accounts, which really must equal zero at this point. They're also on the lookout for suspicious large round number balances or any massive, unexplained changes from prior periods.
To systematically catch those unexplained changes, the controller uses their ultimate magnifying glass, flux analysis. This is an analytical review where current period balances are compared to prior periods, budgets, or prior years. And here's the kicker. Any variance above a specific threshold, typically around 5 to 10%, requires a formal, written explanation from the account owner. It is literally the absolute last opportunity to catch errors before the financial statements go public.
Throughout this explainer, we've essentially been looking at two types of safety nets. We have preventive controls, which stop errors before they even happen, like requiring an independent approval before a manual journal entry can be posted. Then we have detective controls, which catch errors after the fact, like the flux analysis we just talked about, or checking that those clearing accounts are zeroed out. Both are absolutely vital for a healthy financial ecosystem.
Once the flux analysis is fully reviewed, every single variance is explained, and all reconciliations are complete, we reach the final verdict. The controller provides a formal, dated, and signed approval of the close. This signature is the ultimate SOX key control. It's their official declaration that the trial balance is flawless, fully investigated, and ready to be turned into public financial statements.
Which leaves us with one final provocative thought. We've seen the rigor, the controls, and the intense detective work required to truly master the corporate close. So think about your own organization, or even the companies you invest in. If those financials were pulled into the interrogation room today, would the evidence hold up? I hope this explainer has given you the tools to understand exactly what it takes to answer that question. Thanks for joining me on this financial investigation.